Inside the Plan with the 401k Brothers is a production of Horizon Retirement Plans, a division of Horizon Financial Group. Hello, everybody. Bill Bush here.
Andy Bush here.
We are brothers.
And not twins.
Not twins at all. Today, Andy, we're going to talk about traditional versus Roth deferrals inside a 401k. It's a question we get asked about a lot.
Quite often
indeed. And of course, the first thing, to realize is, does your 401k plan actually allow Roth deferrals?
Yeah, most plans do. In 2006, there was a act that was passed, it's a Pension Protection Act that allowed Roth 401k contributions. But not every plan adopted that. So it's important to make sure, first of all, that your plan does allow that kind of a thing.
Okay, so traditional 401k deferrals work how?
So traditional 401k deferrals are taxed as you take money out. As you're putting money in, there's no taxation on a traditional 401k deferral. So I always tell people, hypothetically, you're making $1,000 right now. Before you contribute to a plan, you'd be taxed on the $1,000. If you started to contribute to the plan, let's say you did 10%, so $100, you would strip off that $100 first and put that into your retirement account. Then you would be taxed on $900, which is the remaining amount. And taxation on $900, Bill, is less than taxation on $1,000.
Thankfully.
Right. Yeah.
Thankfully. So if you were, let's just use a round number, 20% is what your taxes were taken out. So before you did anything, your net would be $800.
Correct.
But if you peeled off the $100 that you talked about into the 401k pre-tax, that lowers your taxable income to $900. You're taxed on the $900, which is only, in this illustration, $180. So $180, subtract that from $900, you have a paycheck of $720, whereas before you had a check of $800 because you were taking 20% off the $1,000. So $800 and $720 is only a difference of $80, but yeah, you've put in $100 into the 401k.
Correct. So it doesn't really cost you in take-home pay or drop in take-home pay the actual $100. It only cost you $80.
So then when you get to retirement and you need to access those funds and you start withdrawals, that's when you pay the income tax on those contributions and the growth.
Correct. As you're taking it out, it's just ordinary income tax to you.
So it's kind of like there used to be a commercial back in the 70s and 80s. You can pay me now or you can pay me later. It was the Fram oil filter. And that's really kind of what Uncle Sam is saying. If you have those choices between traditional Roth inside the 401k, pay your taxes now, Roth, or pay them later, traditional. So let's talk about that Roth then. So you gave the example of the traditional. The Roth works, as we said, the opposite way.
Correct. So going back to the hypothetical of $1,000 as your paycheck, what would happen there is you would be taxed on that $1,000 first, and then you would strip out your $100.
So my taxes take my taxes off. I got $800 left, but then I'm taking the $1,000 off. The $100 off, so I'm down to $700. So a $100 Roth deferral is actually that costs you $100
in take-home pay. Correct. Now the beauty of the Roth is that then those monies grow tax deferred, but also tax free, because when you do get to retirement, you've already paid your taxes on those dollars, and you don't have to pay any more taxes on not only just the amount you contributed, but also the growth of that amount.
Now it is interesting. You can actually, it's not an either or situation.
Correct. It's not cut and dry. It's not, directly black and white as to which way you should do it. Every person's situation is different.
And you are allowed to do both if you have the ability inside your plan.
Oh, that's what you were getting to.
Yeah.
Yeah. Exactly. You can do both. You want to get a little bit of a tax break now and a little bit of a tax break later. You could do 50% in each, as long as the total dollars going into your 401k, whether they go in as a Roth or they go in as a pre-tax contribution or both, it can't eclipse or go over that 18,500 for 2018.
And then, of
maximum.
course, you have the 6,000 if you're over 50.
Well, for those special people that turn 50 in 2018, whether they have yet, they can still do 6,000.
And keep in mind, those limits do go up occasionally, a couple of years.
Those limits are subject to change.
They are subject to change. What else about the Roth versus traditional?
I guess when I think of the Roth, I think it's a great program for younger people who are just getting out of college or high school and they haven't quite met their or reached their peak earnings potential and thus their peak tax bracket, right? And so go ahead and pay the lower tax bracket now in the Roth, pay the taxes on those contributions before you put them in. When you're paying and when you're in a lower tax bracket, then when you get to retirement, you can have dollars coming out that you don't have to pay taxes on.
Yeah, so we often get that question, hey, well, which is better? And it just depends. When do you want to take care of that tax burden?
Correct. And so another situation where it could make sense is for someone who's a high income earner later in life, and maybe they don't feel like they're ever going to need those dollars. And so they might use the Roth as a vehicle to not have to take the required minimums out once they get to retirement age.
And so if you do have a Roth account inside a 401k right now and you reach 70 and a half, you would have to take required minimum distributions. Right. But if you rolled that Roth account out into an IRA, then you wouldn't have to. There's no required minimum distribution on a Roth IRA right now.
Correct. I mean, think about it. The federal government wants your tax dollars, and they already got it from you when you put the dollars in on the Roth. So they really don't care when you take the money out.
Yeah.
Whereas on the traditional, you haven't paid taxes. They want to make sure you're paying those. So that's why they do the 70.5 rule for the traditional, but they don't impose that on Roth IRAs.
Well, that's a quick look at traditional versus Roth. If you have any questions, contact us at Horizon Financial Group. abush@horizonfg.com is Andy's email. Mine is bbush@horizonfg.com. And check out the website at horizonfg.com. The opinions of the hosts and guests of this podcast are for general information purposes only and are not to be construed as specific advice or recommendations for any individual. You should consult with a qualified financial professional to determine what is appropriate for you. The advisors of Horizon Financial Group offer securities and advisory services through Cetera Advisors, member FINRA SIPC. Cetera Advisors is under separate ownership from any other named entity.